Hello students. Today in this video I will present to you about the impact of global conflict on the financial statements, especially in the reports of balance sheets. Therefore, the starting question: how the global conflicts affect the balance sheet reports in accounting. Conflicts thousands of miles away can directly change how companies report assets on today's balance sheet, because the geopolitical shocks affect asset values, liquidity, solvency, and disclosure requirements. For example, sanctions, currency instability, and supply chain disruptions force firms to revalue assets, adjust risk disclosures, and sometimes recognize impairments. Let us see the affecting factors one by one. First, the asset valuation. Under the asset valuation, let us see the sanctions and the restrictions. Here, assets in sanctioned regions may need to be written down or reclassified. Example, European energy firms had to impair Russian joint ventures after the Ukraine war. Another, fair value adjustments. Here, market volatility changes the fair value of securities, inventories, and property. Example, airlines revalued aircraft lease obligations when fuel prices spiked due to Middle East conflict. Let us see the second affecting factor, that is the liquidity and cash equivalents. Under this factor, let us see currency controls. What does it mean? Companies may lose access to cash held in foreign subsidiaries. For example, multinationals in Venezuela and Russia reported restricted cash balances. Another factor is the banking disruptions. What does it mean? It means conflict can freeze cross-border payments, forcing firms to disclose liquidity risks. For example, British Petroleum and the Shell Company reported impairments and liquidity challenges after exiting joint ventures in Russia due to the Russia-Ukraine war. Let us see the third affecting factor. The third affecting factor is solvency and debt reporting. Under this factor, we will see higher risk premiums and going concern assessments. What we do mean higher risk premiums? Conflicts raise the borrowing costs and the sovereign risk spreads. For example, the emerging market firms saw debt to equity ratios worsen when sovereign bond yields spiked after Middle East tensions. If you want to refer it, www.imf.org, Media Files Publication 2025. Going concern assessments here means the auditors may require disclosure of conflict-related risks to the long-term solvency. The fourth affecting factor is non-financial assets. In this factor, there are impairments in the insurance and the leases. Let us see the impairments. In the conflicting world, the factories, mines, or offices in conflict zone may be destroyed or inaccessible. For example, the mining companies in Africa and the oil firms in Iraq disclosed impairments due to the instability. Another one is the insurance and the leases. In the conflict world, the firms must reassess lease obligations and the insurance recoveries when operations are disrupted. If you want to refer in the web links in international accounting implications, you can refer it and approve. Another factor that is affected by global conflict is disclosure and transparency in reporting. Here, under disclosure and transparency, we will see risk reporting and events after the financial reporting period. First, let us see risk reporting. The International Financial Reporting Standards, that is the IFRS, and the US GAAP, that is United States of America, Generally Accepted Account Principle, require disclosure of geopolitical risks affecting operations. For example, the banks in Iraq disclosed geopolitical risk exposure to improve the earnings quality and investor confidence. Please refer www.researchgate.net publication. That is the impact of accounting disclosure of geopolitical risks. Okay, another is the events after financial reporting periods. Here, the conflicts may trigger the subsequent events noticed in financial statements. Let us see the real-world examples which are related with the global conflicts and the effects on the balance sheet statement. Here we will see 4 companies. The first company is the British Petroleum and Shell Company. This company impacted in Russia-Ukraine war, and the balance sheet effect is asset impairment and exit from the joint ventures. The second company is Boeing and Airbus. This company impacted in Middle East conflicts, and the balance sheet effect is lease revaluations and higher fuel-linked liabilities. The third one is the JP Morgan Chase. This company impacted in global geopolitical risks, and the balance sheet effect is expanded disclosure on sovereign risk and the liquidity buffers. The fourth one is the Coca-Cola Company. This company impacted in Venezuela sanctions, and the balance sheet effect is restricted cash balances disclosed. Lastly, what are the key teaching insights of this video message? A conflict with long distance miles away matters because the balance sheets are the global documents. Assets, liabilities, and equity are tied to international markets, international currencies, and supply chains. Students, as well as all audiences and the world here should have to understand that the financial reporting is not isolated from the world situations. It reflects the worldwide risks. Thank you for your listening and watching this video. Please like, share, and subscribe this channel. Bye.